So good afternoon, we are XLNC. Our client is Jacob Gray, who incorporated Loan Shark Limited, and Loan Shark Limited purchased the franchise rights for 2 Moneyland Inc. stores in Toronto. So currently, Jacob is considering on selling Loan Shark Limited's accounts receivable and franchise rights back to the Moneyland Inc. or to a third party. So we as CPAs need to give him suggestions on how to improve operations, add value to the purchase price, and which option will give him the maximum proceeds.
The accounting issues identified is in regards to revenue recognition. Revenue is being inflated through improper recognition of the cash being advanced to customers. The amount of advance given to customers is being recognized as revenue in conjunction to the related interest of 20%. There is bias for Jacob to inflate the amount of revenue as much as he can, since the franchise agreement between Moneyland and Loan Shark stipulates that the purchase price will be calculated based on 50% of the preceding year's revenue. IAS 18 is being violated since revenue arising from the use by others of entities' assets yielding interest shall be recognized when it is probable that the economic benefits associated with the transaction will flow to the entity and that the amount of revenue can be measured reliably. Our recommendation is that in order for Loan Shark to comply with IFRS and recognize revenue appropriately, the company should take the following into consideration. The amount of advance given to customers should not be included as part of revenue, since this is an asset that yields interest. The amount of revenue that should be recognized is a 20% interest on the advance that Loan Shark is charging its customers. Another issue is regarding the timing of the recognition, as revenue is immediately recognized when funds are advanced to customers. There is bias for Jacob to inflate the revenue since part of the purchase price is calculated based on 50% of the preceding year's revenue. According to IAS 18, specifically rendering of services, revenue should be recognized when the outcome of the transaction can be estimated reliably. Before the company can recognize the revenue, the following conditions need to be met. The amount of revenue can be measured reliably. This criteria is met since Loan Shark charges 20% interest on the advance, and therefore the amount of revenue is reliably measured. The second criteria is that the stage of completion can be measured reliably. This criteria is also met since the service of providing the cash advance is delivered upon approval of the criteria of the client's application for loan. And the next is that it needs to be probable that the economic benefits associated with the transaction will flow to the entity. This criteria is not met since there's a high degree of uncertainty regarding whether or not Loan Shark will actually be able to collect the advance and the interest accrued. And so our recommendation is that the revenue relating to the interest charged on the advance should not be recognized until Loan Shark actually collects this amount from the customer. Once all the criteria are met, the company can recognize revenue. This, of course, will decrease the current amount of revenue stated on the financial statement and therefore also reduce the purchase price.
There are 3 issues related to accounts receivable. The first issue is that Loan Shark Limited includes the $460,170 interest receivable and the payday advance to the accounts receivable. What Loan Shark Limited is doing is not in compliance with IFRS. By recognizing the interest receivable as part of accounts receivable, Loan Shark Limited is inflating the purchase price of the company. What I recommend is that Loan Shark Limited recognize the interest from the payday advances as interest receivable. This will result in accounts receivable decreasing and lowering the purchase price of the company. The second issue is that Loan Shark Limited were able to recover $89,440 collection relating to 2011-2012. In compliance with IFRS, Loan Shark Limited will have to recognize the credit to allowance for doubtful account, as they will have to recognize the recovery of the account. This will result in a reduction to the purchase price of the company. The last issue is that Loan Shark Limited estimation of bad debt expense does not reflect the current situation the company is facing. In accordance with IAS 37, provisions shall be reviewed at the end of each reporting period and adjusted to reflect the current best estimate. Management may not want to see it to increase their bad debt expense, as that would decrease their accounts receivable and ultimately the purchase price. I recommend that Loan Shark Limited revise their bad debt expense to 20%, as there are higher risks that customers cannot pay the debt, as this has been a trend for the company in the 2013 fiscal year period. As well, 50% of the promissory notes are already past due. This will result in a lower accounts receivable and lower the purchase price of Loan Shark Limited.
So another issue that we identify is that Loan Shark Limited cannot verify and confirm the status of employment for customers that come for advances in the evening hours. Therefore, the company loaned out the money based on their last pay stub. This is significant because it increases the risk for the company, as there is no way to verify that the customer has income to repay back their loan. Relying on the customer's last pay stub is extremely risky for the company because the customer might have employment during that time, but recently because of the recession, they have lost their jobs. Thus, this reduces the customer's ability to repay their debt. So our recommendation is that Loan Shark Limited must verify and confirm the status of employment for the customers before loaning out their money, even if it requires the customers to wait until the next day. This must be done in order to reduce the number of customers that do not repay the outstanding loan balances. In addition, there is bias for Jacob in order to increase the number of customers in order to increase the accounts receivable, since the purchase price is based on 60% of the accounts receivable.
Loan Shark does not have a background check on its employees before they hire them, and they do not have a proper hiring policy. This causes high employee turnover, and they aren't able to train and supervise their employees accordingly. This leads to employees not following procedures and not checking customer identity and references, which causes outstanding accounts receivable, since there's no guarantee that these customers will be able to repay their loan. Our recommendation is that since Jacob has a bias to increase the purchase price of the company, which is based on 60% of accounts receivable, one of the store managers should be responsible for doing background checks on the employees and investigating their new employees, as they're being trusted with thousands of dollars every day. Another issue is the possibility of fraud with the newly hired employee, since his customers are almost identical and their banking information seems to be the same as well. This employee's actions seem to be suspicious, since he has significantly higher collection rates than the other employees, and if the company were to ignore this issue, it would lead to bigger issues of fraud in the future. Our recommendation would be for Jacob to be informed about this issue and get management to look into the issue immediately. They should do a background check and criminal check for the employee, and also determine why most of his customers have the same information and banking information.
Upon Jacob's request, we also look into two selling options to see how Jacob can maximize the selling price. For the first option, Jacob can sell back to the franchise, and the selling price is 60% of the account receivable and 50% of the revenue. However, the challenge is that the calculation has to be based on IFRS financial statements. And for the second option, Jacob can sell to the third party, and the selling price is up to 10 times the earnings after tax. As we mentioned above, there are problems in the financial statements, so we made adjustments. For account receivable, we take out interest receivable because we think it is a separate account. We also take out collections from the previous years because we think that's a prospective adjustment, and we think that the company hasn't made the adjustment. We also adjusted bad debt expense to 20% because we think 20% is a better indication of the business financial position. We add back original bad debt expense, and we have the account receivable before bad debt expense. Then our bad debt expense will be 20% of the amount, and our adjusted account receivable will be $512,000. We also adjust the revenue, and the amount that's consistent with the IFRS is $460,000. And the new selling price, according to after the adjustment, is $582,000. Under option number 2, however, even though there are problems with the financial statements, the net income is not affected, so that the selling price is still up to $2.4 million. So it's very clear to Jacob that the selling to third party can give Jacob the maximized selling price. When Jacob is selling his business, another thing he needs to look at is that he's paying himself salary of $10,000. As a business owner, he can either pay himself salary or draw as a dividend. In this scenario, though, we recommend Jacob to draw the dividend because by saving that $10,000 salary expense, he can increase the net income by $10,000. And in turn, when he sells the business, the selling price can be increased by up to $100,000. The business, though, has to pay additional $1,600 in income tax if Jacob draws the dividend from the business. However, overall, Jacob get a better selling price. So that's why we recommend Jacob to draw dividends instead of pay himself salary.